6 undervalued dividend stocks near their 52-week lows. We're going to run through their historical performance as always. We'll look at their dividend safety, their financial metrics, and we'll jump into the valuation model. As always, each of these have some significant upside, and I'm also adding to a few of these which I will discuss as we go through. So the first one we have is Altria Group. Now this one is down 13.5% over the last year. We can see here towards their 52-week lows with a yield nearly at 10%, 9.53, and a forward P of 8.15. Now, if you've been holding Altria over the last 10 years, you would be up 13.4%. Do bear in mind, though, that this doesn't include those dividends reinvested, and we can see their all-time highs around that $75, $77 mark in 2017. So let's take a look at their dividend safety. We see a score of 55, borderline safe. Market cap 72 billion. It is a large cap company. In terms of those recessionary metrics, well, they increased the dividend during the last recession. They had below average growth, negative 50% versus the S&P's negative 12%, but they significantly outperformed the S&P 500, negative 20% versus the S&P's negative 55%. Dividend increases, well, you may say not too great, but 4.3% is slightly above inflation, as we always advocate on the channel. Around 4% is what we want to aim for, so you are getting a very nice starting yield, plus an increase increasing with inflation year on year, and over the last 5 years on average 5%, the last 20 years however lacking slightly at that below inflationary increase of 2%. We also see they are a dividend king. They have been increasing those dividends for the last 50 years or more. In terms of dividend yield theory, as always, it states a company is undervalued when the current yield sits above the 5-year average, 9.53 versus 8.01, so we have our first sign of undervaluation. We have another sign here with the forward PE 8.1 sitting below the 5-year average of 9.4. So a double sign. Bear in mind though, we're not looking at any of these models in isolation, and we can see the consumer staples sitting much higher at 20. So let's jump into the payout ratio. As always, we do focus on the free cash flow. The earnings, as we've explained many times, is susceptible to manipulation by management through accounting. What we want to see for industry-specific tobacco, 85% or lower. What's nice to note, from 2018, it has been below that. 2022 at 73%, 2023 at 61%, and whilst we note 2024 is expected to come higher, it is still 81% below that maximum 85% that we target. On the free cash flow per share, nice to note the increases over the longer term, 228, so more than double, to 502 in 2022. 627 in 2023, although we can see it is expected to fall in 2024. Nonetheless, over the longer term, whilst we do see inconsistencies, it is increasing over that long-term horizon. Now, sales growth, this is one thing you do need to consider, although it can be on an individual basis in the tobacco company industries. What we want to see is 3 to 7% growth for steady, moderate companies. However, with the tobacco industry, a lot of people do see this as a dying industry. Therefore, we can note the negative to the top line of 2% in 2022 and 1% in 2023. Although a lot of these tobacco companies are looking at new ways, innovative ways to increase their top line. So you could argue this is just a small bump in the road over the longer term. Numerically speaking then, 18 billion in 2014 of the top line, just under 21 in that most recent annual report of 2023. What Altria also do is they return excess cash to investor pockets through share buybacks, reducing it from 1.98 billion in 2014 to 1.78 in the most recent quarter. ROIC, personally, what I want to be seeing here is 10% or more. It gives me faith that management are able to effectively allocate their capital. In the high 40s in the last 2 years, and on top of that, it has been increasing over the longer term. So nice to note, and very, very high numbers, a very strong metric for MO. Operating margin, nice to note, not only is it above the 25%, but it is increasing, so that's always great to see, and it is a very, very strong 59% over the last 2 years. And if you didn't know, it is also a free cash flow machine, 44% in 2022, 54% in 2023, and again, similar to the operating margin, over the longer term, it is increasing in the right direction. So lots to love with these metrics. Finally speaking, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us two things: one, the dividend safety, and two, the balance sheet strength. Now, these are the number of years it would take the company to pay off all of their debt net of cash on hand, and what we can see here, 1.79 in 2023, expected to be pretty much flat in 2024, which isn't a big issue given 3 is our maximum. So based on this information, coupled with that free cash flow payout, the dividend does look to be safe based on my opinion, and we can see the balance sheet does look to be fairly strong. So let's jump into the valuation of Altria Group, and as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button if you want to be continually notified of these videos as they drop. Typically on the channel, we do deep dives of individual companies getting to our intrinsic value. Today's episode, let's jump straight into the calculation, and it is the average of these 4 that you see on screen now, coming to $49. Now, typically what we start off with is a margin of safety of 10%. Now, we use this if it meets 3 criteria: wide moat, strong financial metrics, good forward-looking data. At a 10% margin of safety, we see a buy up to $44. At a 15% margin of safety, not too far off the current trading price. So we see right now with our estimates and judgments a 15% MOS. Now, in terms of Wall Street and their forecasts over the next 12 months, well, they see upside of 12% with a forecasted price target of $46. Now, as always, we can see that they do have a nice upside in the double digits, and also bear in mind with this company, you are locking in a very nice yield touching 10%. Personally, this is one that I have been buying this year as well as last year. Not very often, but when I do see the price come to around that 20 or 15 to 20% mark, between $39 to $41, it is something that I do tend to add to. I do see this personally as undervalued in the current market, but as always, there are risks that you need to understand, and if you do want to see a deep dive we've done on Ultra, going into more than just what we went through today, go check for that episode on the channel. Now, before we move on to stock number 2, just to let you know, we have a free weekly newsletter discussing lots of different topics, completely free if you click on the pinned comment below to sign up, and you have access to a lot of these articles providing value on share buybacks, insider trading, and many others, including our 7 golden dividend metrics. So let's start off with stock number 2, Deere & Company. Now, over the last year, this is down 14%. And over the last 10 years, however, a very strong 324% performance. Nice to note, and it has hit its all-time highs of around $450 a few times over the last few years. We can see the yield, however, 1.61%, so lower than Altria Group, and we do see the forward PE sitting at 13.31. And right there, the 52-week low, it isn't too far off. So let's take a look. Dividend safety score, very safe, 83. Market cap, just under 100 billion, a large cap company. In terms of those key recessionary metrics, well, they maintained the dividend. They didn't cut it, but they also didn't increase it. They had below average growth, but they also trailed the S&P with that negative 65% return. Dividend growth, lots to love, especially if you're a dividend growth investor. Double-digit increase last full year. Double-digit increase over the last 5 years, and a strong 13% increase to the dividend year on year over the last 20 years. But we do note they have only been increasing those dividends for the last 3 years, given they kept that dividend, in fact, from 2019 to 2020. But they have been paying a dividend for the last 30 years without a reduction. In terms of dividend yield theory, then another undervaluation signal on the yield, 1.61 versus 1.3. Likewise on the forward P, 13.5 versus 15.6. And when we compare it to the sector PE, 19.3 for industrials, it does sit higher. Not too far though from that 13.6. So let's take a look at the payout ratio, and what we can see is pretty inconsistent over the last 10 years. But then again, you can argue this is a fairly cyclical company. Below 40% when we're being industry specific for heavy equipment makers, 36% in 2023. Not too bad, in fact pretty positive, and 2024 expected to be 20%. Now for those that are new, this is the reason why we say focus on the free cash flow. In 2022, you take a look, 18%, you'd be pretty happy, but when you look at the free cash flow in 2022, 146%, this is effectively saying that management in 2022 paid out more in dividends than they generated in free cash flow. In terms of the free cash flow per share, very strong growth from $2.39 to $14.10 over the last 10 years. But again, do bear in mind, 1, the inconsistency, and 2, the cyclicality of the stock. 2024 expected to be a very strong year for Deere & Company, essentially more than doubling their free cash flow. Sales growth we see very, very strong over the last 3 years. Double-digit increase. We love to see that. But again, remember the cyclicality. We do see 3 years of negative growth followed by 3 years of positive growth and so on. So again, do bear that in mind. Understand the type of companies you're investing in. Total sales were nearly doubled from 36 million, or billion in fact, in 2014 to 62 in 2023. They also do a lot of share buybacks, as we can see, reducing the shares outstanding from 366 million to 289. Always a positive bonus for investors. ROIC as well, me personally 10% or more. Again, if you want to be more specific for heavy equipment makers, 12%. Nice to note the last 3 years they have been very, very strong on that metric. But again, also notice there was a long period, in fact 6 years, where they were below that 10% level. In terms of margins, pretty inconsistent across the board, although we do note it has been increasing on the operating margin side. The last 3 years, again, very solid performance, which also correlates to their sales, which had a very strong double-digit performance. Free cash flow margin, very inconsistent, although we do note the last 4 years haven't been too bad. 2022, though, a bit of an outlier with that 2%. Finally, the net debt to EBITDA, again, we want below 2.5 for heavy equipment makers, 1.04 in fact in 2023. Now, do bear in mind this is expected to increase significantly in 2024, so just something to include when you're looking at your investment thesis and continuing on with your margin of safety. So let's get into the numbers for Deere & Company, and as always, you can grab a copy of this valuation model to get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio and those on your watch list. So a 10% margin of safety, it is a buy up to 415, 15% up to 391, and we keep going till we're near the current trading price. Now it is pretty much at a 20% margin of safety. For those looking at 25, you would be looking to buy around the 345 mark. Now, typically with a company, if I was looking to buy, 20% would be a very, very strong signal, a very good time to dollar cost average. However, given this is a cyclical company, but it is one that I do like the look of in terms of the metrics, it is one I would be looking to add at around 25%. So around $20 from the current trading price. It isn't too far off, and I do believe once it hits this price, this is one that I will be dollar cost averaging into. I do like the look of this for the long term. In terms of Wall Street and their forecast over the next 12 months, well, they have a price target of $425 and they see upside of 17%. So they do see this as a very strong buy for future growth. And one thing I also forgot to mention that I do like about this is it is a very strong dividend growth company. They do increase those dividends at a very rapid rate. Double digits for the last part, although I do want to point out that for 1 year, over the last few years, they did maintain that dividend. Moving on to stock number 3, we have the oil and gas giant ExxonMobil Corporation. Now they are down around 6% over the last year. Again, if you've been holding them over the last 10 years, whilst this doesn't incorporate those dividends reinvested, you would be up 8%, and we can see their all-time highs not too far off, in fact, in 2023 at $120. So they do offer a yield of just under 4% and a forward PE sitting at around that 12 level. So let's take a look. Dividend safety score 80, it is safe. Market cap 412 billion, it is a mega cap company. In terms of those recessionary metrics, well, they increased the dividend. They had below average growth, but they did significantly outperform the S&P with their negative 28% return. Dividend growth 4.4% in October, so at least slightly above that inflationary rate we always advocate on the channel. Slightly lower at 3% over the last 5 years, but if you've been holding this over the last 20 years, you would be getting at least 7% year on year. They're about 9 years away from becoming a dividend king, and they have been paying those dividends for the last 142 years without a reduction. Absolutely phenomenal. Dividend yield theory, then we can see a sign here of slight overvaluation with the yield lower at 3.66 versus the 5-year average. But again, it's important to understand we don't consider any of these models purely in isolation. And we see the forward PE 12 in line with the 5-year average and not too far off the energy sector PE of 12.9. So let's take a look at the payout ratio. Again, this is a very cyclical industry, and as we can see here, although we do note the last 3 years looking pretty solid around that 40% level for oil producers. 2024 expect to be slightly higher at 51%, but that is something personally I can live with. Free cash flow per share, very strong to note that for a cyclical company, it has been increasing very strongly. 284 in 2014, 826 in 2023, but do be aware 2024 they are expecting that to be lower to around 750. Sales growth clearly shows the cyclicality, and one thing I would say, yes, understand the type of companies you're investing in, but also try and understand that for cyclical companies, maybe the best time to buy them is when they are out of favor. And we can see here in the most recent year, they do have a double-digit negative to their top line of negative 16%. Looking at the last 10 years, we do see that the negative falls around 3 times in a row, or at the minimum 2 times. So we could be in for another 2024 year of negative growth. So numerically speaking, how does that look like? Well, 2014, 365 billion to the top line. 2023, 338. They have bought back shares over the period, reducing it from 4.28 billion to 4.05, so also an additional bonus for investors on top of those dividends. ROIC last 3 years looking very strong, but again, in those years where their top line was reducing by double digits, we do see that ROIC figure fall quite substantially down to negative as well as low single digits. Operating margin, again, the last 3 years looking pretty healthy alongside that free cash flow margin. But again, we can see prior to that, when the top line has been hit very badly, we do note that also the other margins and metrics do tend to suffer. On a more positive note, the net debt to EBITDA 0.13 in 2023, 0.19 expected in 2024. So that dividend does look to be safe, and we can see the balance sheet does look to be very strong. So what about the valuation of ExxonMobil? So let's jump in, and for today's episode, the intrinsic value is coming to a total of $121. Now, in terms of the margin of safety, a 10% margin at buy up to 108, at 15%, pretty much a dollar difference. So for ExxonMobil, we see around a 15% margin of safety. What about Wall Street? Well, they're very bullish on oil and gas as a whole, and in particular for ExxonMobil, they have a price target of $126 with upside of 21%. So similar to Deere & Company, they do see this as a very strong buy. As always, let me know your thoughts as we go along in the comments as to whether or not you are buying any of these undervalued companies near their 52-week lows. We then move on to a company that we haven't covered in quite some time on the channel. It is Walgreens Boots Alliance. Now, they are down 40% over the last year. Over the last 10 years, down 68%. And they're not in the greatest trend, as we can see. Their all-time high just under $100 nearly 10 years ago. They do now offer a yield of 4.6%, which was cut not too long ago, and we can see the forward P just under 7. So in terms of dividend safety, we have a score here of 30 unsafe. Do bear in mind they did recently cut that dividend. Market cap 19 billion, a large cap company. So in terms of those recessionary metrics, they increased the dividend during that period. They had above average growth, and they also slightly outperformed the S&P with their negative 44% return. So as we noted last month, they did have a dividend cut of negative 48%. And even considering that, on average over the last 5 years, it did increase by 3%. And over the last 20 years by 13%. So no surprises, they have 0 years of both consecutive increases and 0 years of paying a dividend. So do bear in mind, given their dividend cut, this will be slightly irrelevant, but we can see their dividend yield currently at 4.6%, sitting higher than the 5-year average of 4.27, as well as the forward PE 6.5, below the 5-year average of 8.8. We also note it is significantly lower than the consumer staples sector PE of 19.8. So in terms of cash flow payout, now we can see here, if you were looking at this, you probably would have signaled that a dividend cut was inbound, as we did mention many times on these episodes looking at WBA. 1,175%. They were paying far more in 2023 in their dividends than they possibly generated in free cash flow. 2024, though, with their new dividend yield of around 4 to 5%, it is expected at 40%, so a lot more healthy when looking at this ratio. In terms of the free cash flow per share, well, $2.92 in 2014. We do see it's 16 cents in 2023, but note it is expected to rebound in 2024. So looking at the sales growth, we do see very inconsistent, although you could argue over the longer term, it probably on average is hitting that 3 to 7% that we look for steady moderate growth. 2023, nice to note, a 5% growth to their top line. Numerically speaking, then, it has essentially doubled from that 76 billion in 2014 to 139 in 2023. They've also done share buybacks. They've also issued shares to dilute your position, but the net point over the last 10 years is share buybacks of around 100 million. So again, positive when you incorporate that as well as those dividends. ROIC, now it isn't the right way that you want a stock to be going for this metric. It is decreasing, but we can see 3% in 2023. I would like to think in 2024 and beyond, they do reverse this trend. But again, always keep an eye on the forward guidance and what management are doing. And we can, if you're interested in, do a deeper dive into this company, looking at the institutions, looking at insiders, as well as a deep dive on the numbers. Free cash flow margin and operating margin both decreasing over the longer term, so we can see why that share price has been hit, why this company has struggled for many years. So when you are looking at this company as an investment thesis, your main point here to consider is whether or not you do see management turning this company around, which they haven't been able to do for the last 10 years. Net debt to EBITDA, even after the dividend cut, is still sits high at 3.69. 2024 at 3.65, pretty much flat. For consumer staples, we are looking at below 3. So again, something just to consider. Given they have done a dividend cut last month, it is unlikely another one will be anytime soon, but always lots to consider. And it's important to add this in when you are looking at that margin of safety. So let's take a look at the intrinsic value for today's episode, and it's sitting at $29.57. So current price, $22. We start off with 10% margin of safety, 15% it is still showing as a buy, and we keep going till it's roughly at that current trading value. At 30%, it isn't quite there yet, so we see a 25% margin of safety, but do bear in mind, just because there's a very high margin of safety, there are a lot of other factors to consider, especially when looking at their metrics and when looking at management and their performance over the last 10 years, as to whether or not you have faith that they are able to turn this around, and that will come into your margin of safety level. Wall Street price forecast, well, $26, so they do also see this as a very strong buy, upside of 19% over the next 12 months with that price target. We then move on to a company that is always on my radar. It is Humana. Now, this is a very strong company, but unfortunately, it did have a very poor quarterly earnings. It is down 29% over the last year. However, when we look over the last 10 years, it is up 223%. And we see all-time highs around $555 last year, or in fact, October 2022. Dividend yield, well, just under 1% now, and we can see a forward P of 22.53. Dividend safety score, the safest score obtainable, 99, very safe. Market cap, 44 billion, a large cap company. In terms of those key metrics, well, they didn't pay a dividend in the last recession. They had above average growth, but they did massively trail the S&P with their negative 72% return. Now, they haven't increased that dividend yet, so we are waiting for an announcement. However, over the last 5 years and the last 10 years, we see double-digit increases to their top line, and they have been increasing those dividends for the last 12 years. So let's take a look at dividend yield theory. We have a huge sign here of undervaluation, 0.98 versus 0.68. In fact, this is nearly the highest yield that they have offered over the last 5 years, other than that pre-pandemic, or in fact at that pandemic point where it did go up to around 1.1%. We also note the forward PE 22.6, however, it is sitting above the 5-year average of 18.6, and also the PE is higher than the healthcare sector PE of 17.7. Now, in terms of the payout ratio, what we can see is below 60%. Now, this is my personal blanket rule for the majority of industries. The reason why I use this, it gives me faith that management are able to offer those double-digit increases to the dividend. And what we can see here is, for the large part, it's been well below 60%. In fact, below 20% other than 2021 and 2015. Most recent year, 15%. 2024 expected 16%. So this is a very strong company, and definitely one that I will be looking to add. Free cash flow per share, $7.07 in 2014, $24 in 2023. So we can see here more than tripled over the period. But again, bear in mind that inconsistency, and we can see here in 2024 it is expected to lower. Sales growth, now we see very strong, double digit to their top line nearly every single year. We do know a very poor double year of 2016 to 2017, but 15% in 2023 is very strong. And we see their top line more than double from 49 billion to 106. Shares outstanding, well, it has also decreased significantly from 156 million to 124. ROIC as well, very strong, well above that minimum 10% I want to see. The last 2 years, 16% back to back. I love to see that. And I also love to see that it's consistently above that level. Operating margin and free cash flow margin does leave a lot to be desired, but we do note the consistencies are between 4 to 6% on the operating margin. Free cash flow margin, again, not something that is too ideal for an investor. We want to see above that 5%. So this is somewhere that they do lack on both margins. Again, do bear that in mind. But something that I love about this company, they have a very strong balance sheet, and that dividend is 100% safe based on this information, as it wouldn't even take them 1 day to pay off all of their debt net of cash on hand. Now, the valuation is always important. If you do like a company, that is the first step. The next is to essentially find out what the intrinsic value is and what is your acceptable buy price. So we have an intrinsic value which is far above the current trading price. So at a 10% margin of safety, 438. At a 20%, we can see it is still an acceptable buy. At 25%, again, not too far off the current trading price. So we can see looking very, very strong. In terms of Wall Street and their expectations over the next 12 months, well, they see this as a very, very strong buy. Their price forecast $475 with upside of 31%, making it the largest upside so far from the stocks we have reviewed. And this is one that I will continue to add to my portfolio at this very nice margin of safety. For those who want a much larger margin of safety at 30%, well, you would be looking at $341. And we can see that that mark is pretty much right there at their 52-week low. So let's jump on to the next stock. We have British American Tobacco. Now, this is one that is very popular in the community, again, for that high yield similar to Altria Group. It is down 21% over the last year. Over the last 10 years, down 44%. And we can see quite some time ago before it hit its all-time highs of $72. In terms of the yield, we're around 9.5%, not too far off that of Altria Group's, and we see the forward PE at 6.66. Not sure that might be a bad sign. So dividend safety, 45, borderline safe. Market cap, 67.5 billion. It is a large cap company. Now, in terms of those recessionary metrics, well, in fact, not too bad. They increased the dividend, they had above average growth, and they also outperformed the S&P. Yes, negative, but if you were in the S&P, you would be down a much larger rate. Now, do bear in mind they do pay out their dividends in GBP sterling, so this will have some FX rate differences, but we can see over the longer term they have been increasing those dividends at an above inflationary rate. They are also 1 year away from becoming a dividend aristocrat, having paid 24 years of consecutive increases. In terms of dividend yield theory, well, that double sign of undervaluation, the yield above the 5-year average, and the current forward PE below the 5-year average. And we also note it is well below the consumer staples of 19.8. Now, in terms of the payout ratio, what we can see here, it is decreasing over the longer term. And for a tobacco company that pays a very high dividend, this is very low at 51%. Noted 2024 is at 65%. But these are some very, very positive values to be looking at, especially when that dividend is such a large part of their free cash flow. Free cash flow per share were 162 in 2014, 455 in 2023. So again, it is increasing over the longer term. That is always positive to see, especially for industries that you could question in terms of the sustainability for the longer term. And 2024, though, we can see it is expected to drop slightly. In terms of sales growth, well, very inconsistent. In fact, the last year at negative 1%, with the year before looking very strong at 8%, and the 2 years before that looking flat, goes to show the inconsistencies across this industry and this company. In terms of the top line, well, essentially doubled from 14 billion in 2014 to 27.3 in 2023. And we do know, unfortunately, unlike Altria Group, they do issue shares, so they have diluted your position over the longer term, increasing from 1.87 billion to 2.23. ROIC, again, it is lacking a bit if you do want to directly compare it to Altria Group, which was in the 40s. 2023 at 12%, still not the worst, but again, some people do want to see around 15% as a minimum for tobacco companies. Margins, however, no worries whatsoever. It is also increasing similar to Altria on both fronts and very, very strong on both levels. So they are operating very, very efficiently, and they are, you could argue, a free cash flow machine. Net debt to EBITDA looking healthy, in fact 2.65 in 2023, 2.7 in 2024 expected, so below that 3 that we expect for tobacco companies. So again, no major worries here, especially when we consider the free cash flow payout in terms of that dividend safety, and the balance sheet does look fairly strong at the moment. So in terms of the valuation for BTI, let's jump into that and see whether or not this is a strong undervalued buy. We get an intrinsic value of $47. Now, with the current price at $30, that is a huge margin of safety. Again, at 10%, we start a buy up to $43. At 20%, up to $38. And we keep going towards the current trading price. And we see it sitting around that 35% level. Don't forget, you can grab a copy of this valuation model if you want to get to the intrinsic value and acceptable buy price of companies in your own portfolio and on your watch list by clicking on that pinned comment below. So a 35% margin of safety based on our estimates and judgments, and Wall Street see, whilst they believe the forecast over the next 12 months is below our intrinsic value, They see some very, very strong upside, nearly in line with Humana stock at 29%. Their price target of just under $40. So again, all of these companies looking like very strong undervalued buys. But as always, I'm interested to hear your thoughts, whether or not, similar to Wall Street, you see these as strong buys, whether maybe you have been adding, or maybe for whatever reason, these aren't really stocks you are looking to add to your portfolio. As always, if you've enjoyed today's content, smash that like button, hit that subscribe and bell button if you want to be continually notified of these videos as they drop. And as always, have a great day and see you on the next one.